Good day, my name is Bianca Haywood and I will be taking you through Sun International's results presentation. Please do note that I will not be answering questions throughout the session. However, you're more than welcome to ask questions. Please type your questions into the chat box and I will be responding via email correspondence. Let's take a look at what we will be covering today. I'm going to start off with the nature of business, followed by the recommendation, the financial review, divisional overview, company guidance, and conclude with the portfolio guidance. Let's take a look at the nature of business. Sun International has a diverse portfolio of assets, including five-star hotels, modern and well-located casinos, and some of the world's premier resorts. Sun International is one of Africa's largest tourism, leisure, and gaming groups, and has an interest in a total of 19 resorts, luxury hotels, and casinos. Sun International's entry into Latin America began in Chile in 2008. Sun International's Latin American profile has now been merged with casino and hotel profile of Chile-based leader in the gaming and entertainment industry, Dreams SA, making it the largest gaming company in Latin America with operations in Chile, Peru, Colombia, and Panama. Now moving over to the recommendation. The group has an attractive portfolio of operations. The group has a solid track record, boosting good margins, exceptionally high return on equity, and strong cash generation, which can be attributed to the group's defensive nature of operations. The gaming industry in South Africa has come under pressure in the last couple of years due to the subdued economy and the introduction of alternative forms of gaming, such as limited payout machines and electronic bingo terminals. Deteriorating economic conditions will continue to place pressure on the casino business. Gaming operations are defensive in nature, and the regulatory environment helps limit competition. The National Gambling Act limits the number of casino licenses that may be granted to 41 for South Africa as a whole. Gaming revenues, although resilient, are not immune to economic cycles. Demand for hotel rooms continued to grow, with little growth in the hotel supply over the last few years. We believe that the group is well positioned for growth over the medium term as the benefit of the strategic initiatives starts to materialize. The group has around 15 billion in debt, of which 11 billion is attributable to South Africa. Following the negotiations with the group's lenders, the group's debt covenant levels were adjusted and the group remained within these levels. The new properties in Latin America should begin to make a contribution to profits as these operations are ramped up. The successful completion of the Dreams merger will strengthen the group's position in the market. The share price looks attractive, trading at a forward P of 8.3 times, well below its historic average. However, disappointing revenue growth and the challenging economic outlook, which combined with the narrow margin that the group is trading to its current bank debt covenant, does not inspire confidence, and we would only recommend the share to speculative investors, given the uncertain impact of the deleveraging initiatives. Now moving over to the financial review. It is important to note that the group changed their financial year-end from 30 June to 31 December in order to align with its Chilean operations. Accordingly, the group's EPS ranges for the 6-month period from 1 January 2017 to 30 June 2017 are being compared against the pro forma results for the prior corresponding period from 1 Jan 2016 to 30 June 2016. Sun International delivered a disappointing set of results. Revenue rose 19% to 7.6 billion, benefiting from the inclusion of Sun Dreams and Sun Slots for the full period, as well as Times Square for 3 months. Adjusted EBITDA rose 16% to 1.9 billion, which combined with a 29% increase in the depreciation and amortization expenses resulted in a 9% increase in adjusted operating profit to 1.2 billion. The adjusted operating margin declined to 15.3%, down from the 16.8% in the previous year. Profit before tax was fairly flat at 666 million, mainly due to a 23% increase in the net finance expense, due to higher interest charges following the inclusion of Sun Dreams for the full period, as well as the opening of the Times Square Casino. Ultimately, both adjusted headline earnings and adjusted headline earnings per share came in 29% lower at 206 million and 198 cents per share respectively, impacted by a higher share of profit attributable to non-controlling interest, following the disposal of the 10% interest in SunWest and Worcester in April 2016, as well as the consolidation of SunDreams and Sun Slots for the full period. Given the challenging trading environment and the need to reduce the high levels of debt, the group has decided not to declare an interim dividend. Now moving over to the divisional review. South Africa continues to contribute the majority of the group's revenue at 68%, with Latin America contributing 31% and Nigeria the remaining 1%. Gaming revenue made up the bulk of the group's revenue, contributing 73% to the group's revenue, while alternative gaming contributed 7%, food and beverage 9%, rooms 8%, and other revenue contributed the remaining 3%. Let's take a further look at the South African operations. South African operations contributed 68% to group revenue. Revenue rose 6% to 5.2 billion. While SA like-for-like casino revenue declined by 4%. Hospitality operations performed well, with room revenue up 9%, while food and beverage revenue rose 10%. The international business recorded a significant drop in revenue as the group struggled to achieve the volumes and continued to struggle to collect outstanding debt. Accordingly, the group has decided to suspend the international business operations. EBITDA was slightly lower at 1.3 billion, while on a like-for-like basis, EBITDA declined by 9%. Operating profit declined by 11% to 804 million, resulting in a lower operating margin of 15.6%, down from the 18.6% in the previous year. Now taking a look at the South African casinos. Grand West revenue declined by 2% as slot revenue came under pressure, specifically in the top-end play. Strong growth in table revenue was achieved. Overall footfall was up, however the average spend was down. Operating profit declined by 13%, resulting in a lower operating margin of 30.6%, down from the 34.6% in the previous year. Sun City's revenue before the vacation club adjustment rose 6%. Casino revenue was increased by 5%, room by 18%, and food and beverage by 4%. The average daily room rate increased by 6% to 1,771 rand. Operating profit grew by 73%, resulting in an improved operating margin of 3%, up from the 1.9% in the previous year. Sun Central was opened in November 2016, following the 375 million refurbishment and upgrade to the conference centre. Occupancies improved from 66% to 70%, assisted by the refurbished conference centre, which was fully booked in 2017. Table Bay's revenue rose 5%, while operating profit grew by 23%. Supporting a higher operating margin of 21.1%, up from 18%. The average daily room rate increased by 8%. Occupancies was down 1% to 79%. Sibaya's revenue and operating profit rose 6 and 11.5% respectively. The operating margin improved from 27.3 to 28.6. The group's property grew market share to 35%, up from 34% in the previous year. Management indicated that the food and beverage and non-gaming entertainment offering is due for an upgrade in the next 6 months. Times Square Casino was opened on the 1st of April 2017. During the 3 months since its opening, revenue of 276 million and operating profit of 27 million was achieved at an operating margin of 9.8%. Times Square Casino captured 13.4% of the Gauteng gaming market share in the first quarter. The Gauteng gaming market share has not grown in the last quarter. However, the group expects revenue to grow further with the opening of the new arena in November 2017 and the hotel in March 2018. Shows booked for the arena in November and December are fully sold out. The Times Square development costs are in line with its initial budget of 4.2 billion. Carnival City's revenue declined by 14%, with table and slot revenue down 29% and 10% respectively. The footfall increased while the average spend continued to decline. Operating profit fell by 44% to 74 million, translating into a much lower operating margin of 15.7%, down from the 24.4% in the previous year. The group will continue to focus on driving the footfall through events to counter the effect of lower average spend. Broadwalk's revenue declined by 7%, with casino revenue down 9%. Management expects recent opening of an electronic bingo terminal outlet in Uitenhage to further impact revenue. An operating loss of 6 million was reported. The group are looking to restructure this business. The Maslow Hotel grew revenue by 3% on the back of higher occupancies of 71%, up from 68% in the previous year. Average daily room rates was in line with the prior year, while an operating loss of 23 million was recorded. Other casinos, which consist of small urban casinos, was impacted by the challenging trading conditions. Revenue declined by 7%, while EBITDA was down 16%. A new 80-room hotel was opened at Merope after reporting dates, which should assist revenues going forward. Now let's take a further look at the Latin American operations. Latin American operations contributed 31% to the group's revenue. The group's Latin American operations is now successfully integrated with Dreams SA. Revenue increased from 1.4 billion to 2.3 billion, while operating profit grew by 91% to 358 million. The operating margin improved from 13.6% to 15.3%. Casino revenue still made up the bulk of Latin American revenue, followed by food and beverage revenue. Taking a further look at the Latin American operations, Chile's revenue declined by 0.3% in constant currency, while Chilean properties, with the exception of EQQ and Monticello's performance, was in line with expectations. EQQ's performance was impacted by the mining industry. Monticello was impacted by the relocation of the toll road and the close of the casino for a 12-day period, following the tragic shooting incident in July on the gaming floor of Monticello. Monticello opened a new smoking deck, a 4,000-seat arena, and a new bar in July 2017, which all had a favorable impact on revenue. Panama's revenue declined by 4%, while an EBITDA loss increased from 6 million to 37 million due to the increased marketing, promotions, and tournament costs. The group decided to dispose of its 65th and 66th floors in the Trump Towers and refocus the VIP business to an area on the main casino on the 3rd floor. Some of the slots were relocated to an alternative location downtown. These initiatives are aimed at reducing the costs. The Colombian investment did not meet expectations, and the group is looking to downsize or exit this business, alternatively reducing the term of the Colombian property lease. The lease term has 2.5 years remaining. Peru's revenue declined by 3%, while EBITDA declined to 23 million, down from 25 million in the previous year. SunDreams is finalizing the acquisition of Thunderbirds Resorts, which consists of 4 gambling operations. The purchase consideration of approximately 27 million consists of 11 million properties. The acquisition represents an opportunity for SunDreams to strengthen its position in the Peru market and diversify its asset base in Latin America. Now moving over to Nigerian operations. Nigeria contributed 1% to the group's revenue. In 2016, the group has decided to exit the country. The process to exit has been initiated, but it may take some time as the group seeks reasonable value for the investment made. The Nigerian trading environment has continued to weaken. Revenue declined by 28%, while an operating loss of 13 million compared to 25 million in the previous year was recorded. Now taking a look at the group's gearing. The group has around 15 billion in debt, of which 11 billion is attributable to South African operations. Following the renegotiations with the group's lenders, the group's debt covenant levels were adjusted and the group remains within these levels. In South Africa, the group has a debt to EBITDA ratio of 3.9 times, which is still below the group's covenant level of 4 times. The Chilean operations has a debt to EBITDA ratio of 1.4 times or 2.6 times prior to netting cash, which is still within the group's covenant level of 4.75 times. Now moving over to the company prospects. The local trading environment is expected to remain challenging. The group remains dedicated to cutting costs and have implemented a back-to-basics drive, which is aimed at improving operational efficiencies. Although casino revenue is expected to remain under pressure, Sun City's revenue is expected to improve following the recent refurbishment of the resort. The opening of the arena and the hotel at Times Square is expected to help drive footfall and support revenue growth in coming months. The Chilean economy has shown early signs of recovery, and an improved second half performance is expected at Monticello, the group's largest casino in Chile. The Chile municipal license bidding process is currently underway. Sun Dreams intends on submitting bids for a number of licenses. The outcome of the bidding process will only be announced in the first quarter of 2018. The group plans on increasing its shareholding to 65% in Sun Dreams, in line with its strategic objective to increase its interest in Latin America. Operations in Panama and Colombia remains disappointing, and the group is working towards downscaling or exiting these businesses. The 4.2 billion Times Square development has entirely been funded with debt, which resulted in an increase in the overall gearing in South Africa. The group will follow a prudent approach to reduce its debt and strengthen their financial position. The group is currently also evaluating a number of opportunities or options to reduce the group's debt. Now moving over to the portfolio guidance. Sun International has a weighting of 0.1% in the cap specs, and we would recommend exposure of up to 3.1%. Please take note of the following disclaimer. That concludes my webinar for the day. Should you wish to place a trade, please contact our trading desk. If you want to ask questions, please type your question into the chat box and I will be getting back to you via email correspondence. Thank you and enjoy the rest of your day.